You've been there, right? Staring at your portfolio at that one stock that's just deep in the red. Every logical bone in your body is screaming, just sell it! But something in your gut, it just won't let you. It's a universal and frankly, a very expensive investing mistake. Today, we're going to pull back the curtain and look at the psychology of why it is so incredibly hard to just let go.
It really is the question every single investor has to ask themselves at some point. You know the company's fundamentals have changed, you know the opportunity cost of having your capital tied up is just growing and growing, but still, you hesitate. So why does this one simple action feel so monumentally difficult?
Well, that feeling of being totally paralyzed, it's not some kind of personal failure. It's actually a feature of human psychology. We're going to unpack these powerful cognitive biases, the ones first identified by the pioneers in behavioral finance, that are basically hardwired into our brains, compelling us to cling to our losing investments.
To really get to the bottom of this, we have to step away from the trading floor for a minute and into the world of psychology. The whole explanation kicks off with this revolutionary idea called prospect theory, which completely turned the old-school economic view of a perfectly rational decision-maker on its head.
At the very heart of it is a concept called loss aversion. It was first figured out by these two psychologists, Daniel Kahneman and Amos Tversky. And it's a simple but really profound idea. We are all fundamentally wired to feel the sting of a loss way more intensely than we feel the joy of an equivalent gain.
Just think about it in your own life for a sec. Finding a $100 bill on the street, that feels great, right? It totally makes your day. But losing $100 that you already had in your wallet, that feels absolutely devastating. It can ruin your whole week, even though the actual amount of money is exactly the same.
In fact, studies in behavioral finance have even tried to put a number on this. And for most people, the psychological pain of a loss is about twice as powerful as the pleasure from a gain of the same size. That is a huge emotional imbalance. And as you can imagine, it has massive consequences when we're trying to make decisions about money.
Okay, so we've got this little quirk in our human brains. How does it actually end up sabotaging our investment returns? Well, it shows up in the market through a couple of well-documented and pretty destructive behavioral patterns.
It's called the Disposition Effect, and it's the direct result of loss aversion playing out in our portfolios. It's all driven by this powerful, deep-seated desire to avoid regret. We are basically predisposed to dump our winners way too quickly and cling desperately to our losers for dear life.
So here's the psychology. Selling a losing stock feels like you're officially admitting you failed. It takes that paper loss and makes it a real, painful mistake. So we hold on, just hoping it'll crawl back to what we paid for it and erase our error. It's kind of like a financial marshmallow test. We choose to avoid the immediate pain, even if it leads to a worse outcome down the road. But selling a winner, that gives us an immediate hit of gratification. We lock in the profit and, this is key, we avoid the future regret of watching that profit maybe disappear.
And as if that wasn't enough, there's a second trap that makes the disposition effect even worse. It's called anchoring. The second you buy a stock, that purchase price becomes this powerful psychological anchor. From that moment on, every future decision you make about that stock gets subconsciously tied to that initial number, even when it's completely irrelevant to the company's real prospects today.
And what's truly fascinating, what's really wild, is just how deep this bias runs. This quote here, it comes from a study where people were explicitly warned about the anchoring effect. They were told what it was and told to avoid it, and they still couldn't do it. Just knowing the trap exists isn't enough to stop you from falling right into it.
Okay, so we know the psychology is pretty much working against us here. But the good news is that by understanding these biases, we can actually build systems and strategies to fight back. It's all about taking that raw emotion out of the equation.
So how do we do it? Here are 4 solid steps. First, create an exit strategy before you even buy the stock. This means setting a clear stop-loss rule when you're calm and rational so your emotions can't take the wheel later. Second, you have to actively fight that anchor price. Ask yourself this really powerful question. If I had this money in cash right now, would I buy the stock at its current price? If the answer is no, well, there's your decision. Third, automate things. Use periodic rebalancing to make selling a mechanical process, not an emotional one. It turns a huge, painful decision into just a simple routine. And finally, and this one's tough, you have to decouple your ego. A losing stock doesn't make you a bad person or a dumb investor. The smartest move isn't trying to prove you were right all along. It's getting that capital working in a better opportunity.
So after digging through all this psychology, what's the most important thing to walk away with?
This is it, the most important takeaway. These biases aren't a personal failure, they are part of our shared human psychology. Loss aversion, anchoring, the fear of regret, they're all just part of our mental operating system. The goal isn't to become some kind of investing robot. It's to recognize these tendencies in yourself and then build a rational framework that protects your long-term goals from your own short-term emotional reflexes.
And that leaves us with this final thought. The battle against these biases is actually won before it ever really begins. It's won by creating a plan when you're calm and rational so that you can just execute that plan when the markets get choppy and your emotions start running high. So the question I want to leave you with is this. What is one rule you can put in place today to make your future investing self more successful?